Okay, so this is our topic, the evaluating farm health using the financial ratios. But before we move on to the farm health, let us start from the financial ratios and how do you use all those financial ratios in the context of the financial economics. So basically, we shall be talking about an investor who will be investing in a particular firm. So our money is, of course, hard-earned money for us. So we should be very careful about investing in the particular asset. So before we could invest in a particular asset, we shall be considering some aspects. And here we shall be talking about some financial sector indicators. And of course, we shall try to link all those indicators to the fundamental health of the firm. So before we move on to the choice of the asset, let us consider the different types of investors who play in the market. So in the market, we have three types of investors basically. So the first of all, the risk lover investor, then the risk neutral and the risk averse investor. Now, why it is important to discuss about the different investors? Now, this is important because whenever we are taking some investment decision, so basically it is a decision which is based on our attitude towards risk. I shall be coming to that later on. So first of all, let us now distinguish between the different types of the investors. So who is a risk lover investor then? So a risk lover investor loves taking risk, and he or she will be getting additional pleasure by taking the risk. So he or she would always prefer higher return or rather, if we put it in this way, so whenever we are talking about the risk and the return of the investor, so risk is definitely a bad thing and return is a good thing. So whenever we are taking a decision, we shall think about all the risks and the returns profile of the asset that we shall be getting. So a risk lover investor will always prefer to take some risk. So the return doesn't matter much to them. For the risk neutral investor, the situation is different. The risk neutral investor is just neutral between the risk and the return, so that he or she will be interested in taking the risk, but he or she will not be interested or not be bothering much about the return of the investment. Now then comes the risk averse investor. So this type of investor is basically the most important type of the investor that we shall be talking about. Because whenever you are taking a decision, a risk averse investor, if I am a risk averse investor, then I'll be more interested in return rather than the risk. Now, when we talk about the investment in the stock market, we have all these types of investors. And whenever we talk about analyzing financial health of the companies or we talk about the portfolio selection, we basically talk about the risk averse investor. Because if a person is risk lover, then he or she will be preferring the risk. So there is no question of hedging that. And more or less the same thing will be applicable for the risk neutral investor, because he or she will be just indifferent between the risk and the return. Therefore, in our analysis,
Ma'am?
Yes?
Some people are waiting to enter, I think.
Okay, so, yeah, so let me. because when I am I think nobody else is waiting. So
Ma'am,
yeah,
are you sharing your screen because we can't see
no,
anything?
no, no, no. Right now I am not sharing. Right now I am not sharing. So some people are waiting so that I am trying to admit them. So please wait for some time. So I think more or less 51 people have joined. So let's wait for 1 or 2 minutes more. I think nobody is waiting. Now, if you find someone waiting for admission, so please let me know. Okay. Okay. So, what I was talking about, we were basically interested in the behavior of the risk-averse investor and how he or she could hedge the risk of investment. So, in the stock market or in any kind of financial market, there are basically two types of investors. One is the rational investor, and the other is a speculator or the momentum investor. Now, who is a rational investor? A rational investor will always be guided by the fundamental health of a company. So, what is meant by the fundamental health of the company? Now, it may be the profit, the sales, the exports, the real economic variables or the real economic activities of the firm. So, if that is good, then that performance will be reflected in the stock market. So, the rational investors believe that any good financial performance should be backed by the real fundamentals, a strong fundamental. And if this link is missing, then there is no point in investing that particular asset. But what about the speculators or the momentum investors? The momentum investors or the speculators will always be taking their decisions on the basis of the prices. So they are not at all interested about the fundamentals. So this is actually the most dangerous point or most dangerous aspect of the financial market or the stock market. So what does a speculator do? A speculator will always be interested in some asset that has a high price in the stock market. Now, from where does this high price comes? Now, this high price, may be backed by strong fundamentals. So maybe the company is really good, and if the company is good, then its stock market performance is also good. So if that is the case, and if speculators are interested in that, then there is actually no problem. But the problem lies elsewhere. Suppose that the company is not fundamentally that strong, but still it is highly priced in the market. So how is that possible? So in that case, actually, the speculators, or rather, how is that possible? So let us first consider that. Now, suppose a new product, a new financial product, a new asset, or anything new, it may be a new innovation, it may be a new idea that comes into the market. Now, whenever it comes into the market, there may be some assertions from the media, from maybe media, financial analysts, and often the financial gurus who will be claiming about the future potential of all these firms. So they tend to rely on the four most dangerous words in finance. Now, these four most dangerous words in finance are apparently very simple. So the words are, this time it's different. Okay, now I think there are some people trying to add bits. So okay, so this time it's different. So suppose the asset is selling at a very high price and that is not backed by the fundamentals. Then why should investors be interested in all those things? Now the point is that the rational investors will not be interested in all those assets. So who will be there then? So it will be the speculators or the momentum investors. So they will be more interested in the prices. So feel that there is a demand in the market, so that they create the some more demand backed by, because their optimism is backed by the assertion of those four most dangerous words in finance. So then they will try to create a high demand for the product or for the stock rather. So prices will also rise, and in that way, there will be a price rise which will not be backed by the fundamentals. So this is typically the formation of a bubble in an economy, in the stock market. So bubble generates when the stock prices are not determined or are not backed by the strong fundamentals. Now the bubble will be pricked at any point in time, because speculators are not irrational. Although we make a separation between rational investment and momentum investment, but please do not assume the speculators to be irrational. Perhaps they are more rational than the investors, or more calculative than the investors. They can always find out the price beyond which the market cannot go. But unfortunately, this price, which is called the trigger price, will be different for different individuals. For example, suppose I am an investor and I have a stock of Infosys. Now, at any point in time, suppose I believe that the price of Infosys share cannot go beyond say 2,000 rupees per share. So in that case, if I feel or if I find that the stock price of Infosys is say 2,100, then I may not be interested in the stock anymore, because now I believe that the stock trigger price has been reached, and after that the prices are going to fall. So therefore, I'll be selling off my share. I'm no longer interested in the share. But what about the others? Now, others will be having the different trigger prices. Now, this trigger price is based on the perception of the investor. Now, here lies the important distinction between the actual and the perceived. So, the speculators play on the basis of their perception. So there may be some other investors who feel that the trigger price for Infosys may be 2,500. Then what then they will be do when the price of Infosys is 2,100? They can do two things. One is either they will be sitting tight with the share because their trigger price is 2,500 and it is yet to be reached, or alternatively, he or she can apprehend that, okay, this person has sold off his or her share, so there might be something wrong in the economy. Then why should I sit tight with my share? Let me sell it off. So the second person sells it off. Then what happens in the economy? Two people have sold off their shares. Then there is a third person. Now perhaps this person may have his or her trigger price to be much higher than 2,500, even it may be 3,000. But since two persons have sold off their shares, he or she may be interested in selling off the shares. So now three persons have sold off their share. So now a panic will be developing in the economy. So everybody will try to, or rather, they will apprehend that something might be wrong in the economy. So it's better to sell off the share. So now an increasing number of individuals will try to sell off their stocks. So if that happens, then the price will fall. And eventually, if this fall is drastic, that might even lead to a crisis. So this is what is meant by the herd behavior. So everybody will be following his or her friends or other persons in the economy. So what the rational investors are doing then? The rational investors are there. So they are seeing that the bubble is generating in the economy. Say, why don't they do anything? So they may take some decision so as to stop the bubble in its track. But the literature suggests that it is very difficult to stop a bubble in its track. So the rational investors usually just sit tight with their stocks, and rule of the game becomes the momentum. So it will be determined only by momentum and the herd behavior. And initially, which was irrational exuberance, so everybody was very much optimistic about the stocks. So now they will be, all that optimism will be turning into irrational pessimism. Now I'm calling it irrational pessimism because the irrational exuberance thing is clear. The prices may not be backed by the fundamentals, but still the individuals are going for that in their speculative interest. But when the bubble is pricked, then everybody will make their anticipations or perceptions to have a revision downward. So there will be a pessimism. So this pessimism may be very strong so as to ignore any kind of benefit that might be generated by the stock. So this irrational pessimism is really very bad for the economy. Now we have seen that earlier in the context of the IT stocks, and possibly we are now seeing one of such bubble in the context of the green stocks. I'll be coming to that later on, the green stocks and the associated problems. So given this, we can mention one thing, that every crisis, every financial crisis is termed as a crisis of perception, right? So the different financial crises may be different in nature, or they may originate from different sources. The effects may be different, but in all the cases, there lies this problem of perception. So whenever the actual or the reality does not match the perception, there will be a problem. So whenever we are taking any investment decision, we should be very careful. So we should be depending on two things, the actual as well as the perception. Now, whenever we are talking about the financial ratios and evaluating the firms on the basis of the financial ratios, then we shall be considering these two aspects also. So we shall consider the actual scenario, and there will be some perceived cases also, some perceptions also about the firms, and there are ratios which will be giving us, or which will be showing us the perceptions, right? So now we shall be trying to find out whether the perceptions match the reality. So we shall be taking a particular firm and we shall try to find out whether the perceptions will be matching for the reality. So if perceptions do match the reality, then there is no problem, we can go for that. Now if the perceptions are not matching with the reality, then probably there is a problem. I'm not making any strong statement that there will be a problem. I'd rather make this comment that make this statement rather that possibly there will be a problem, so we should be very careful while investing in that particular asset. Now before we move on to the financial ratios, let us very briefly consider the definition of a firm. So what is a firm? A firm in financial economics literature is a way of organizing economic activity of individual. Now each and every firm will be having two types of decisions to make. One is called the capital budgeting or the investment decision. So the firm will have to choose a profitable investment opportunity. So there are different assets, different projects available to the firm. So the firm will have to choose the asset which will be most profitable for them. Now there are different routes for choosing different assets. So in this workshop or in these lectures, we shall not be talking about the capital budgeting or the investment decision. So one such very common rule is net present value criteria. So we shall be choosing an asset, or a firm will be choosing an asset if the net present value is positive. So there are many other alternative decision making criteria, so we are not going into that. Now the point is, once the firm tries to, or rather once the firm finds out the different assets in which it is interested, then it will have to find out the ways to finance the assets, so from where the money will be coming. Now very briefly, there are two broad ways of financing. One is called the equity or the shares, and the other is the debt. So these are the two broad instruments, financial instruments, and a firm can find out the optimum capital structure or the optimum way of combining the equity and the debt. Right? Now, as I am trying to point out, each instrument will be having its own advantage and own disadvantage. Now let us talk about the equity. Now when a firm sells shares in the market, then what happens? The firm has decided to raise a particular amount of money from the share market. So this amount of capital will be divided into small equal shares. So each unit is called a share. So it will be selling, it will be having a particular face value, say 10 rupees. But when it is selling in the market, then it may have a higher price. So each unit will be called a share. Now the point is, any shareholder is the owner of the organization. Therefore, this owner will be having a right on the profit of the firm. So the owner or the shareholder will be getting a portion of the profit. So this is called the dividend. Now, the owners will be having some other rights also. They will be enjoying some rights. They will be having the voting powers, and their power will be depending on the number of shares that he or she will be having. Now, the point is, this dividend is not a liability or obligation of the firm. So, the dividend may be paid to the shareholder, or suppose there is profit, but the firm may decide not to go for any dividend payment. This entire amount of profit may be retained for future investment. Now, this retained investment will be very important from the point of view of the investor. So, I'll be coming back to that later on. Now, so we have the equity holders on one hand. And so that's one of the advantage. Dividend is not the liability or obligation. But what is the disadvantage? If we have too many shareholders, then we shall be having too many owners in the firm, and at some point of time, it will be having some problem. The second instrument is the debt instrument. So simply, a firm can borrow from the market, from any financial institution. Now, once the firm gets the debt, or once the firm borrows, it will have to pay regular interest payment, and after a certain point of time, it will have to pay back the principal amount. Now, from the point of view of the firm, there are certain advantages or disadvantages so far as the debt is concerned. The interest payment is an obligation. So interest must be paid first of all, and then the equity holders will be given their dividends. So if the firm has some gross profit, then out of that, first interests will be paid, and then there will be taxes. So interest payments are obligations. If the firm is not paying the interest, or if it is defaulting on its loan, then given the conditionalities, the debtor may drag the firm into the court. So that is also possible. But there is another advantage. The debt holders are not owners of the corporation or of the firm. Of course, interest payment is liability, but they are not owners. But too much of debt may not be very good, because first of all, the financial obligation will be increasing, and secondly, there will arise a very important conflict of interest between the equity holder and the debt holder, because the dividends are not obligation, but the interest payments are obligations. So first the debt holders will be getting their dues, and then the equity holders, if anything else is left, then it will be going to the equity holders. Right? So this problem becomes much serious when some financial crisis is anticipated. So this conflict of interest gives rise to a particular type of cost, which is called the agency cost. Equity holders or the owners will be taking certain decisions, or they will be taking certain actions which will be not good for the firm itself. So there will be some costs, under investment, investment in the risky project. Most importantly, there may be a problem of milking the property. So suppose some crisis is anticipated. So in that case, the equity holders anticipate that the profit after the payment of interest and taxes will come down to zero. Therefore, nothing will be left for dividend payment. Then in that case, the equity holders can take the decision to sell off some of the firm's asset. So that is why it is called the milking the property. And this amount of money will be going back to the equity holders as the additional dividend. So here lies one very important problem. So as investor, often we are interested in the dividend. Suppose a firm is paying a higher dividend, so we may be very, very interested in that. Okay, this firm is giving us higher dividend, additional dividend in a particular quarter, so we should go for that. Now, additional dividend may not always be good, because additional dividend, if it comes from milking the property, then it is not a good sign for the firm's financial health. Now, it's very difficult to find out whether it is milking the property or this additional dividend is coming from the additional profit. Now, whether the profit is increasing or not, that can be easily visible from the financial statements that we shall be considering later on. But this milking the property will be generating out of the perception of the equity holders. They are anticipating that a crisis will be there and the net profit will be driven to zero, so that nothing will be left for them. So this additional dividend may not always be a good thing. The reverse is also true. Paying no dividend is not always a bad thing, because as I have mentioned earlier, the firm can retain 100% of its earning as retained earning for future investment. So in that case, dividend is zero, but still there is a possibility for future opportunity. So that creates a perception about the future profit. So whenever we are talking about the dividend, or whenever we are thinking in terms of the dividend, we should be very, very careful, because no dividend is not always a bad thing and additional dividend is not always a good thing. So from here, actually, we start to learn a basic rule about basic rule or basic understanding of the analysis of financial ratios. So there will be different ratios available, but the problem is that all the ratios will be necessary, but not neither of them will be sufficient. So you just cannot take decision on the basis of a particular financial ratio. So that will be a great mistake. So if we just concentrate on only one or two indicators, then that will be a very, very bad decision. So whenever you take a decision, there are so many indicators, so many areas. So just try to focus on all those things. So there are three basic legal forms of organizing the firms. So I shall be moving in these three things briefly, and before we move on to the financial statements. So the sole proprietorship, partnership, and the corporation. Okay. So the sole proprietorship, as the name suggests, the business is owned by only one person. So the owner himself or herself is the manager. Now, this is once again, this is advantageous on some count and disadvantageous on some other. Okay, now I had just another thing to mention here. Now, so far as the equity and debt advantages and disadvantages are concerned, there is
Ma'am,
yeah, please. Someone is
we cannot see your screen, ma'am.
you can see yours. Okay, let me see. Can you see now? Is it visible now?
No, ma'am. Not yet.
What about the others?
No, ma'am, the screen is not visible.
Okay. Now, is this visible?
No, ma'am. Ma'am, I think if you open the slide and then if you share it through that a Chrome tab or a window.
Right. So let me do that.
A window, through that you can do that.
Sharing the window.
Yes, ma'am. Yes, ma'am. Now it is coming.
Okay. Okay.
Yes, ma'am.
Fine. Is this visible to all of you?
Yes, ma'am.
Okay. Okay. Fine. Okay. 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 So what I was just trying to mention one point, that often it is not possible to get date for the firms. So firms often do not get dates from the traditional financial institutions. So why that should be the case? Now, suppose we are talking about a new firm or a new entrepreneur. So maybe the firm is not there, only the entrepreneur is there, and there is the idea. Uh, Even there may not be the product, it may be the idea only. So in that case, but the point is the idea has immense profit potential. So in that case, the traditional financial institutions will not be interested in financing all those projects, because what they are interested in is collateral. So it may be tangible or it may be intangible. So tangible collaterals, these new firms, they have no tangible collaterals to offer. Moreover, since they are the new firms, they are yet to develop their product. So they may not have any intangible intangible collateral to offer. So this is particularly the area where the firms will be going for the entire equity financing, and this is where the venture capitalists come in. So the venture capitalists are usually the wealthy individuals who will be interested in anything new, any new product, any new idea, any new concept, provided there is any long-term profit potential. Once again, perception. And that perception should be strong enough so that it will be turning into reality, and the venture capitalists will be helping all the firms. They will be investing in every way so that this potential ultimately is converted into the actual profitability. So when we are talking about the firms, we may not get a firm which has debt. So the firms may be all equity financed also. But in reality, you will never be getting a firm which will be relying 100% on the debt, of course, for obvious reasons. Okay, so let us now move on to the sole proprietorship. So as the name suggests, it is the business owned by only one person. So there will be a single owner and single manager. Now this is advantageous because this will help this particular type of organization to avoid one important conflict of interest. So I'm just coming to that. Now the cheapest business to form, no charter required, fewer government regulations. So it is the cheapest business to form. In terms of corporate taxes, or in terms of taxations rather, there will be some benefits. Now, the point is the responsibility or the liability will be unlimited. So it is the owner who is taking all the decisions. So the owner will be taking the capital budgeting decisions and the investment decisions as well as the financing decisions. So he or she will have to arrange for the money, and the life of the business is limited by the life of the sole proprietor. The second form is the partnership. So you can have the general and the limited partnership. So two or more people will be forming an organization. It is not that expensive, but licensing and the filing fees will be necessary. Now, so far as the responsibility is concerned, the general partners will be having a limited responsibility. And the limited partners' liability is limited to their contribution. Now, in case a general partner fails to meet the obligations, then the responsibility will be falling on the other general partner. Now, so far as the termination is concerned, the general partnership is terminated when a general partner dies or withdraws. Now, it is very difficult to transfer the ownership without dissolving, so all the partners should agree. Now, limited partners may also sell their interest in a business. Now, once again, it is difficult to raise a large amount of cash, so it will depend on the partner's ability and the willingness to contribute. There will be some tax benefits. And there will be some partners who will be managing the thing. So management control will be with the general partners, and there will be a voting, of course, for the important matters. Now these two type of organizations will not be our concern, so we shall be talking about a corporation basically. So it is an incorporated association, a distinct legal entity, and it will enjoy, so it should be and it is enjoying many of the legal powers of a natural person. Now starting a corporation is not easy, so the incorporators must prepare articles, so charter of incorporation. So there will be certain bylaws which will be abided by. Now, the articles of incorporation will include the different things. So, name of the corporation, usually it is, or rather, it should be unique. We should not have more than one in process. Intended life of the corporation, usually it is unlimited or infinitely or infinity. Business purpose, in which segment it is entering, or which type of product it will be producing. Number of shares that the corporation is authorized to issue. So each and every corporation will be authorized to issue a certain amount of shares, so that they are entitled to raise a certain amount of money from the share market. So that is mentioned. And the nature of rights granted to the shareholders. Once again, this should be granted. Nature of rights granted to the shareholders. Okay. Now, in the corporation, there will be the shareholders, board of directors, who will be elected by the shareholders, and the managers of the corporate officers or the executives. So the shareholders are the owners, and there is a separation now between the ownership and the management. Now, here lies the second source of conflict. As I have mentioned earlier, I have already talked about a source of conflict between the debt holder and the equity holder that might lead to some agency cost. And now we have the conflict of interest between the owner and the manager. So why, or rather, what's the nature of this conflict of interest? Owners will be interested in the profit, right? Because they have a certain portion of the profit that will be going to them. And the managers will be interested in the sales. Now, as we all know, profit maximization or sales maximization may not always lead to profit maximization. So the owners will always be interested in maximizing the profit, and the managers will be interested in maximizing the sales. So there may be some problems associated with the costs. So costs may be artificially increased, or there may be some wastage, so that sales may be maximized but the profits are not. So here lies the second source of conflict of interest. So whenever we are taking a decision, then we should be careful about all these things. So a firm typically will be suffering from two types of conflict of interest. Okay, so with this, actually, we have finished our introduction, and then we have introduced some basic concepts, and how should we go for assessing the financial health of a firm. So now we shall be considering the financial statements. So if you are talking about a firm and its performance, then where should you search? What are the different documents that you should search for to comment on the financial health? Now, in our analysis, we shall be depending on the publicly available information of the firm. So the publicly available information will be including the financial statements of the firms. So here we shall be talking about the balance sheet and the income statement, and I'll not be going into the cash flow statement and then financial ratios, and later on I shall try to compare this analysis with the stock prices of the firm that I'll be choosing. Okay, so I'll be choosing a typical firm on the basis of the financial ratios, whether investing in that firm will be profitable or not, and then we shall consider the stock market performance of that, basically the stock prices of that firm. Okay, so up to this point, is there any question or is there any clarificatory thing that, or any clarificatory point that one would like to raise? So do you have any question, anybody? Any question or
Good evening, ma'am. Good evening, ma'am. Am I audible? Am I
yes,
audible?
yes, you are audible.
Yeah. This is Samrat Banerjee, ma'am. I'm from
Yeah,
St.
so
Xavier's
you have
University.
a question and you have
Yeah,
written
I've
that
written
in the chat box. Actually,
Yeah.
the problem is when I'm sharing the screen, I'm not being able to see the chat box. So that is why I'm not, I was not being able to see that. Okay, so
not
you
an
have
issue.
a question. Yeah. So the conflict of interest arises between profit maximization and sales maximization. Okay. The problem is, now see, profits. What is profit actually? Profit is the total revenue that the firm earns minus the cost, all types of costs, right? So sales or the revenue will be the target of the managers. So from that, some costs will be subtracted so that ultimately we are reaching at the profit. Okay, so the point is, suppose you are maximizing the sales, and at the same time, in order to maximize the sales, you are taking some decision that are increasing the costs. So in that case, your profit will not be that high. Okay, so that is a possibility. So if that happens, and that is a possibility, so there is a possibility of conflict of interest. Profit maximization may not always mean, or rather, the reverse. The reverse is the thing. So if sales is maximized, profit may not be maximized. Yeah. Okay, anything else?
No, ma'am. Thank you. Yeah.
Okay, okay. So anybody? Okay, so and from the students of Presidency University, yeah.
I have a question.
You are not audible, please.
This is Partha Tarak. I have a query. That is, can dividend be capital profit?
You are not audible. Could you please write in the chat box?
Can dividend be paid out of capital profit?
Can dividend be paid out of
Capital profit? That is milking of assets, as you mentioned, that selling of the fixed assets and all. That results capital profit. So, can dividend to shareholders be paid out of capital profit?
Yes, it can be done. Even if the company repurchases its shares, then that amount can also be distributed as profit. That is the dividend policy. But dividend policy may be irrelevant for the firm, but it is also possible. It is also possible. Therefore, what I was then trying to point out that depending too much on dividend may be too risky. Right, so you should have to identify the source from where the additional dividend is coming. That is very difficult. Okay, so I think Sarthak has a question. Explain the nature of conflict between debtors and the equity holders. Okay. The point is that debtors, the interest payments are first made out of the profit. So suppose you have profit, it will be more clear when I'll be considering the income statement. I'll be doing that in 5 minutes or so. So out of the gross profit, first the interests are paid, then the taxes are paid, and then what is left is called the net profit, which is available for dividend payment, or it is retained with the firm for future investment. Now, in that case, so first the debt holders are getting their dues, right? So, in that case, suppose there is some crisis situation so that the profit falls, and after the payment of interest and the taxes, nothing is left for the equity holders dividend payment. So, in that case, debt holders are getting their dues, and the equity holders are getting nothing. The point is the debt holders may not get their entire amount. So that is called the partial bankruptcy. So the obligations may be met only partially. So that is partial bankruptcy. And if the gross profit is zero, then debtors are not going to get anything. So that is an extreme situation. But suppose we are assuming that the gross profit is positive, so that the interest payment is there, so the debt holders are getting something, but net profit is zero, so there is no dividend for the shareholders. So in that case, the interest, the debtors are getting something, the equity holders are getting nothing. So equity holders are getting nothing just because of the fact that the debt holders are there. So there lies the conflict of interest. And of course, the firms will be having some debt, because the capital structure will be a combination of debt and equity, right? So there arises a conflict of interest, and it is from the point of view of the equity holders, not from the point of view of the debt holders. So that is why the equity holders are taking some selfish decisions. So be it under investment, be it investment in the risky project, be it milking the property. Okay. So is that clear to you, Sharka?
Yes, ma'am. Thank you.
Okay. Okay. So Ruchi, this dividend is equally divided among employee, managers, and owners. No. No. The owners will be getting the dividends, and there are some concepts like employee decision-making scheme or something like that. In that case, the equity holders, the managers will be getting some. Okay, just wait for a minute, because my current is off, so I'll be going for another. Okay. Okay. So the point is, yeah. So often the managers get some stocks as some compensation scheme or something like that. So in that case, they are entitled to get the dividend, right? But usually it is the owners or the shareholders who will be getting the dividend. And if the employees, if they have the shares of the company, then they are entitled to get the dividend. Okay, so got the point. If you have the share, then you are entitled to get the dividend. You just sell off the share and your entitlement goes. Vedochisha has a question. Can you give some example of how companies might milk the property? So some assets may be sold off. Some good assets may be sold off. Right. And the equity holders are taking their decision. So it can be done. So only some good assets are sold off. That is the example of milking the property. Okay. Okay, so any other question, or otherwise I'll be Moyuk. Yes, Moyuk has a very interesting question. As dividend is not an obligation, then if a firm doesn't pay dividend, then why will anyone be interested to buy its stocks? Okay, so dividend payment. See, dividend payment will be suppose zero dividend payment, right? So you are talking about zero dividend payment. So zero dividend payment may be coming out of zero profit, or it may be the case that the company is retaining 100% of its earning. So in that case, the firm has some perceived investment opportunity. So that gives some value for investing in that firm. And what I am trying to emphasize is that do not rely only one indicator. Okay, so a firm doesn't pay dividend does not mean that you will not be interested in that firm. There are so many other indicators. You will have to consider all the other indicators. So if you just rely on only one indicator, you are basically a myopic investor. So you are considering only one aspect of the firm. So you are not considering the different aspects that should be taken into consideration.
Okay, thank you.
Okay. Oindrila, dividends up to a limit is tax-free, but is retained earning taxed? Retained earning is not taxed. It is a portion of the net profit, profit after tax, that is retained. Okay, so already the tax has been. Now, this question will be answered once I go into the income statement and the balance sheet. Okay. Okay, so any other question? It means conflict of interest between owners and debtors will exist only in case of loss. In case of profit, owners will get an advantage if debtors are present by way of financial leverage. Okay, so that is one point. But the other thing is that suppose your gross profit is increasing and there is no interest payment, then after taxation, the entire amount may be distributed as dividend if the company decides to do so. But suppose there are debtors or the creditors, then there will be interest payment. So whatever is gross profit, out of that something will be going to the interest, something will be going to the debt holders. So in any case, the equity holders will be getting lesser amount. But of course, you are right in that case that there will be some financial leverage, but financial leverage once again will be having its advantage and disadvantage. So what I am trying to point out many a times that you should not depend too much on only one indicator. Okay. So the conflict of interest will always be there and it will be aggravated if a crisis is anticipated. So if the crisis is actual, then of course there is a conflict of interest, actual conflict of interest, but it will be there even if a crisis is anticipated. Now, suppose the company is doing very good, very, very good in terms of, or it is very strong fundamentally, but still there may be some anticipation of future crisis. So in that case, there will be a problem. So the conflict of interest will always be there.
Ma'am, I have one question.
Yes.
Hello, ma'am.
Yes.
Yes. Ma'am, actually, my query was regarding the format of balance sheet. Previously, according to Schedule 3 of Companies Act 2013, we used to take in the vertical format equities and liabilities in the first instance, followed by assets. But nowadays, under the sectional balance sheet format, we are taking assets at first and then liability.
Assets, liability and equity.
So is there any reason behind that, behind changing the format?
No, there is no. So the basic thing is remaining the same. And so far as our investment decision is concerned, so it will not going to hamper anything. Okay, so this is basically a decision under financial economics. So we shall be using only the concepts used in the balance sheet and the profit and loss, right? So that all these questions, as long as the basic understanding or the interpretation of the ratios remain the same, there will be no problem in making the decision.
Yes, ma'am. The format is same. The format is different, but the entire output is also same, and the decisions will also be similar. Yeah. But is there a reason behind changing the format?
No, right. Right now, I just okay. I'll have to go into it.
Okay. Okay.
Probably I can give you the answer on the next day. Okay.
Okay, ma'am. Sure, ma'am. Sure.
Okay. Okay, so Ruchi has another question. Can we say rational investors are speculators? Very difficult question. Rational investors are not speculators as such, because if you follow the broad definitions followed in the financial economics or in crisis economics, then rational investors are basically, they are the value investors. So they are mostly dependent on the fundamentals, right? So if the fundamental is strong, then they will be going for the investment in that particular stock. So that is the case. So usually they are not speculator, right? But you know, the demarcations are very fine. Some speculators, as I have mentioned earlier, some speculators may be more rational than the so-called value investor, right? So their speculation may be based on the fundamentals. So in that case, some rational investors may also be speculators. So given the fundamentals, they might speculate. Okay. So they might find out the undervalued securities and they can invest there and they can make a profit out of that. Okay. So okay. So now I'm once again going back to my presentation. Oh, is it visible? Is it visible?
Yes, ma'am. Yes, ma'am.
Okay. Okay. So now we are moving on to the balance sheet. As you see here, that one thing you should do, somebody is unmuting himself or herself. Please mute. Somebody is unmuted. Okay, thank you. Thank you. So there will be two types of financial statements that we shall be talking about. The first one is the balance sheet and the second one is the profit and loss account or the income statement. Okay. So here we shall be considering only the broad items, and then we shall be moving on to a particular balance sheet of a particular company. Now I'll be showing you one particular balance sheet, and if you are interested in some other companies also, so we can also discuss those things. Okay. So the broad headings. Now, whenever we are talking about the balance sheet, we are saying that we were talking about the asset of the firm, right? So the asset of a firm will be financed by the two main financing instruments. Now the balance sheet shows you, in a nutshell, the balance sheet shows you the different assets of a company at a particular point in time and the ways the assets are financed. So on one hand, you have the total valuation of the asset and how these assets are financed. These assets are financed either through the debt or through the equity, right? So that means on the other hand, you will be having the liabilities plus the stockholders' equity. So liability is nothing but the debt and the stockholders' equity. Now, a balance sheet will be published annually, but you can have quarterly balance sheets also, quarterly data on balance sheets also. I will be showing you the one of the very reliable website also that will be giving data on the balance sheet and profit and loss of the companies. That is free. There are certain other websites and certain other packages. For example, you have Prowess, where you can get the company level data also. So I'll be showing you the free website from where you can get a reliable data. Okay, so balance sheet will be basically available after the end of the financial year. So for the Indian firms, you will be getting balance sheet as it stands on 31st March for a particular year. So as I have mentioned earlier, it will be showing the assets and the liability and the stockholders' equity. So it is based on this particular identity. Now, what is the difference between the identity and the equality? Identity is always true, right? Now, why it should be assets should identically equal to liability plus equity? Because in a particular year, if a firm has a certain amount of asset, then and it has some amount of money to finance all these assets, then these should be identically equal, because you have purchased all these assets and you have financed all these assets, right? So these are the two ways of giving you the same thing. Okay. So here I'll be showing you in columns the balance sheet, that is the textbook description. But when I'll be showing you the real life example of a balance sheet, you will be getting it in the form of first the assets and then the liability and the stockholders' equity in that way. Okay. So in the asset side, we have the current asset as well as the fixed asset. So assets are divided into two types, the current as well as the fixed. Now, current assets are basically the short-term assets and the fixed asset are the long-term asset. Now, what are the current assets then? And the total asset, of course, will be the sum of the current asset and the fixed asset. Now, within the current asset, you will be having cash and the cash equivalents. Now, current asset is the most liquid form of asset. So either it is cash itself, cash equivalent, or any asset which is easily convertible into cash. So under the current asset, we are having these broad categories. But if you look at the real life balance sheet, you can have, depending on how the data is presented in the website, you will be having many other components also. But these are the major heads. Okay, so first of all, we have the cash and the cash equivalents. So that is the most liquid form of asset. Then the accounts receivable. Accounts receivable means, suppose that the company, so on the asset side, you will be showing all those entries for which you will be receiving something. So that is your receipt side, to be very or rather in a very simple one. So suppose you have given something on credit and against which the invoice has already been generated. So that is also the case in case of exporters and importers. When we talk about the balance of payments in the international economics, then suppose some goods or services have been provided on the basis of credit, but for which some amount, some bill or invoice has already been generated. So this is the accounts receivable. So you are going to get the amount of money within 1 year, right? So it is basically a short-term asset. Now, notes receivable. Notes receivable means, now accounts receivable is not associated with any interest payment. So if that is, suppose you have sold some goods or services to another party, B, then after a certain period of time, B will pay you back, but this time difference is not associated with any interest payment. But in case of notes receivable, there will be some interest payment associated with it. So suppose you have given some money as loan, short-term loan basically, because current asset is always a short-term asset. So if you have given some loan and after a certain period of time, you will be getting back the interest and the principal amount, but it is within 1 year. So that is why it is the notes receivable, and some interest will be associated with it. Now in some textbook, I'm following two references basically. I'll be giving you the references at the end of the workshop. So in some cases you may get only the accounts receivable and not notes receivable, but in some cases, of course, notes receivable. Okay. And then it comes the inventory. Inventory is nothing but the unsold or the stock of goods. Now, this inventory may be positive, negative, or zero, because inventory may be accumulated, decumulated, or it may become zero. Inventory accumulation means you have produced more than what you can sell, so demand perhaps is not there, so that you have kept the inventory. You have to keep the inventory. Or alternatively, suppose you want to give some trade to the firms. Okay, so suppose you are one of the major players in the market. So in that case, there will be every possibility that other firms will be entering into the segment. So how to restrict those firms to enter into that segment? So in that case, you just keep the inventories. Why? Because it is just one way to give a threat to the new entrants. So just enter the market. I have the inventory. I'll produce enough of the good. I'll flood the market with the goods, and the price will be reduced to such an extent that you will just not be able to stick to the business. So probably that may be another way. So inventory. So it is also a short term, and of course it's an asset, so it's a short term asset. So the total current asset is the sum of all these four items. So that gives us the total current asset. Now you come to the fixed asset. Now within that, the first thing is the property, plant, equipment, all kinds of capital goods that a firm has. Now, since all the capital goods will be having its wear and tears, so there will be certain depreciation over this period of time. So the firm's total or the net fixed asset will be these gross fixed assets minus the accumulated depreciation. Therefore, when we are talking about the fixed asset, it is rather the net fixed asset, that net tangible fixed asset rather, that we shall be talking about. So in the fixed asset, as you see, there is a difference between the tangible assets and the intangible asset. So within the tangible asset, you have the plant, equipment, and the properties, less the depreciation, and then you have the intangible assets. So you may have patents, goodwills, reputations, anything that is a result of research and development, so intangible assets. Okay, so the total fixed assets will be the tangible assets plus the net tangible asset plus the intangible assets. So you can find out the total asset as the sum of total current asset plus the total fixed asset. Now, very briefly, we now move on to the liability and the stockholders' equity. Now, within that liability side also, you have the long-term liability and the short-term liability or the current liability. Now, the current liability or the short-term liability are those with maturity period of less than 1 year. Now, there is a modern definition of short-term or long-term also. Now, it is often said that it is the time to maturity which should be taken into consideration rather than the actual time of maturity, So, for example, say initially any asset was or any liability was of a maturity of 2 years. Now, suppose that was 2018 and it was going to mature in 2020. So, in 2020 or in 2019, what is the amount or what is the time to maturity left? It is less than 1 year. Therefore, it should be treated as a current liability or current asset. So, that is one of the way of defining the short term or long term. But here we shall be following the traditional definition, so that current liability or short term liability will be essentially the liabilities with less than 1 year of maturity. So what do we have under the current liability? So this current liability, as we shall be showing later on, will be matching this current asset portion. So within this current liability, we have the accounts payable. So this is just the opposite of accounts receivable. So suppose you have taken something on loan and you will have to, against which bill or invoices have been generated, and you are going to pay it back after, say, within 1 year. So that will be accounts payable. B, then notes payable. Notes payable is the same thing as notes receivable. Now, as far as I understand, the accounts payable and notes payable will be differing in terms of the associated interest payment. So notes payable will be basically the short-term obligations associated with interest payment. Now, accrued expenses. Accrued expenses are the expenses that the company is going to meet, or suppose it has been met, but against which the bill or invoices are going to be generated. So in that way, it is different from the accounts payable. For the accrued expenses, the bill or invoices are yet to be generated, but of course that is current liability. So the sum of these three will be giving us the total current liability. Okay. Now coming to the long-term liability or the long-term debt, long-term borrowing. So we have two types of debts, long-term liabilities here. One is the deferred taxes and the secondly is long-term debt. The deferred taxes, okay, first of all, we consider the long-term debt, then I'll be going to the deferred taxes. The long-term debt is the debt or the borrowing with a maturity period of more than 1 year, in a very simple sense. I'm not talking about the other definition. Okay, so long-term debt and the deferred taxes. Deferred taxes means for a particular financial year, the firm is not paying the amount of tax that it is entitled, or rather it is to pay. Right. Now, this deferred tax may arise due to many different reasons. It may arise for accounting reason. For example, say, suppose I believe that, suppose I feel that the tax rate is 20%. So on the basis of that, I have calculated the current tax and I have paid that. And after a certain period of time, I realize that, okay, the tax rate is actually 30%, so that I have paid less. So this much is the deferred tax. So the amount of tax that I have not paid, right? So since it's a liability and it's a long-term liability, so it will be appearing under the liability side. Therefore, here you can find out this A plus B gives you L2, which is the total long-term liability. So you can find out L1 plus L2 also, which will be giving you the total liability. Okay. Now, this L1 will be matching A1 here, but this L1 plus L2 will not be matching A1 here. So A1 is matched with L1, but L1 and L2 might help us to take decisions in certain cases, so that it will be giving us the total liability. Okay. So the stockholders' equity. Now, in the stockholders' equity, or if we talk about the shares or the stocks, there are two types of stocks: the common stock and the preferred stock. So the common stock or the ordinary stocks will be giving its owners will be giving the owner the entitlement, or not, I'm not calling it a right, the ability to get the dividend, and the owner will be having voting rights and some other rights also. But in some cases, stocks will be coming with some other preference. So that is called, or some other advantages. So that is called the preferred stock. So it is common stock plus something. So the preferred stockholders will be having some advantages. They will be paid the dividends before the common stockholders. So it may be the case that the debt holders are getting their dues, preferred stockholders are getting their dues, but the common stockholders are not getting their dues just because of the fact that there is no profit. Okay. So common stock plus the preferred stock. So I'm not going into details of these types of stocks because, as you know, we are not talking about the details of the balance sheet or the profit and loss account. That is not the idea of this workshop. So we shall have these statements at the back of our mind, and on the basis of that, we shall be taking some decisions. And for that, we shall be discussing only the important issues. Now, if anyone has any query, then he or she is free to raise the question, and I'll try to answer. I may not be give the answer today. Okay, so in that case, you may also mail me so that I can give you, or rather, I'll try to give you the answer. Okay. So next comes the capital surplus. So capital surplus or reserve. So see, the valuation of the share may be changed. Suppose a firm is a stock, when it is sold in the market, it will be having some face value. Now that face value is actually very small, right? So now suppose when the firm is selling the shares, when the shares are actually sold in the market, then it will be much higher. The prices may be much higher than the original face value. So in that case, there will be some reserves and the surplus or the share premium. In some cases, the capital surplus is called the share premium also, or the reserve and surplus. So these are also the part of the equity. So that will be coming here. The next important thing that will be coming under stockholders' equity will be the accumulated retained earning. So this is the, as I have mentioned earlier, so why it should be a portion of the equity, why it should come under the equity. So so far as the logic goes, it's a part of the net profit, right? So net profit is either being distributed as dividend or it is being retained for further investment. So this amount of retained earning could have been distributed as profit. It's not a liability. Could have been distributed as dividend, but it is not being distributed. So it should come under the stockholders' equity. And this is the amount of money which is available for further investment. The fifth one is the treasury stock. So this is the stock of the company which is not held by the common people. Suppose the company, I'm just giving an example. Suppose that a company wants to buy back its shares, repurchase of the shares. So earlier the shares were there in the market. So now the company has bought all the shares back. So these stocks are not now with the common investors in the market. So that will be treated as the treasury stock. So in the equity side, in the stockholders equity, we are considering the equity that is going to the, or that might go to the stockholders equity. That might be going to the stockholders equity, or that might be related to the common stockholders equity. Now treasury stock is something which is not related to the stockholders equity. Therefore, when you are calculating the total stockholders equity, then we should sum up the first four: common stock, preferred stock held by the general public, capital surplus or reserve related to equity, accumulated retained earning related to common stockholders equity, minus the treasury stock, because it is not the stock owned by the common stockholders. Therefore, now we have the total stockholders equity as A plus B plus C plus D plus E. So A plus B plus C plus D minus E. So that gives us E1, which is the total stockholders equity. Therefore, the total liability plus equity will be this L1, current liability, L2 plus E1. So ideally, this total asset side will be equal to the total liability plus equity side. Okay, so that is actually the basic idea about the balance sheet. Now, I'll not be going into the analysis of, or rather, I'll be showing just the balance sheet here. This is the balance sheet. So I have different companies here. 10 companies actually. So this is Larsen and Toubro, and I have 5 years data from 16 onwards to March, from 16 onwards up to March 20. So
Ma'am, it is
I'll
not
be
visible.
Okay, Abar. Okay,
You have to
let
share another
no,
screen.
no.
You have to change the screen share.
Okay. Visible? Is
Yes,
it
ma'am.
visible?
Yes, ma'am.
Okay. Okay. So so that will be the balance sheet and profit and loss account. Actually, I have 10 companies here, so I can show you, but of course that will not be done today. So tomorrow, let me do the profit and loss account first, or then I'll be showing you the data, and then I'll be going into the financial ratios. Okay. So now, just tell me, up to this, is there any question? Okay, we already have question. Liquidity is also a part of asset. Liquidity is also a part of asset. What is the meaning of that question, Ruchi? Yeah, some assets may be liquid, so that is a characteristic feature of the asset. Liquidity is a characteristic feature of the asset. So we don't say that liquidity is also a part of the asset, right? So some assets may be liquid, some assets may not be that liquid. So under the asset part, the most liquid assets will be coming under the current assets. So they are most liquid. Parthasarathi, is treasury stock fictitious liability? I don't think so. It is not fictitious liability. No, it is not a liability. It's a part of the equity which is not held by the common stockholders, right? So I am just buying back the shares, and the company is now retaining the shares with it. So these stockholders, these stocks are no longer in the market. They are not outstanding stocks in the market. In that case, it is not a liability. I don't think it's a fictitious liability.
Ma'am, if the stocks are not held by anyone, like I mean, these stocks has been brought back by the company.
Yes.
Okay, so there aren't any stockholders to these stocks right now.
No. No.
So if any dividend will be paid, then in regarding these
No,
stocks,
on
it
treasury
is very.
stocks. No. On treasury stocks, there will be no dividend paid. So see, we are the common stockholders, and the dividends will be given to the common stockholders. So these stocks are with the company itself. It is not with the board of directors either. It is with the company itself. So it is just keeping idle with the company.
So, ma'am, like if the company has purchased back these stocks, then there is no capital which these stocks are contributing to the company
No,
anymore.
of course not, but that will be having some advantage also. If you buy back the shares, so number of shares outstanding is going to reduce in the market. So there are some indicators, some financial ratios that are based on number of shares outstanding in
Ma'am,
its denominator.
if a stock is not contributing capital to the company and cannot be used, the fund or the capital contributed cannot be used to buy or invest in any fixed assets, then isn't it fictitious?
See, you may call it a fictitious liability, but who is bearing the liability? In what way you are calling it a liability? Just because it is not contributing to the firm's valuation, or it
So
doesn't
then
have
should
any
it come? Should
contribution.
it come fictitious? Because I'm saying, because then should it come actually in the part? Should it be a part of the balance sheet itself?
No, no. It's a part of the equity. Now, see, in the balance sheet, in the liability plus equity part, you have the stockholders' equity, right? So, treasury stock is a stock which is not owned by the stockholders. So, that is why it is coming under equity, but it will be subtracted. It is not available for investment, right? But
Okay, it
why
will be
the firm should?
subtracted.
Yes, it is subtracted. If you go to the, okay, then I'll have to once again share the screen. If you consider the total equity side, stockholders' equity, then what do you have? You have common stock plus preferred
Yes.
stock plus reserve surplus plus retained
Mhm.
earning minus the treasury stock, right?
Okay,
So
ma'am.
by
Now
that,
got it. Now I got it.
okay, so probably you have missed that in the.
Yeah.
Okay. Now is it clear to you?
Yes, ma'am. Thank you.
Okay. Um, Shomik, perhaps I have explained the treasury stock again. Shorish, so am I liable to myself in case of treasury? No, you are not liable. You are not liable. The stocks are just with you. You have repurchased your stocks with some, of course, with some strategy. You have actually improved your valuation. As I have mentioned earlier, number of shares outstanding will be reduced. So that will be increasing your valuation in context of some ratios. Okay, Ruchi has under the current asset, all type of asset. Ruchi, under the current asset, all type of assets comes liquidity is one type. Am I right? Okay, Ruchi, I'm not getting your question very properly, but yeah, so all the assets under the current asset will be relatively more liquid. So of course, some will be more liquid, some will be relatively less liquid. For example, cash is the most liquid item and inventory is not that liquid. But of course, these are all liquid and they can be converted into cash or similar type of assets. Diroktimava has a question. If the inventory is negative, inventory negative means you are basically decumulating the inventory. Right, so you are decumulating the inventory. Inventory will always be there in the asset side. So if there is enough demand, so you will be depleting your inventories. Ayush, Mitra, ma'am, is treasury stock some kind of firm's financial security? What is meant by that, Ayush? Financial security means what?
Ma'am,
Or do
like
you,
if
yeah?
the part if that if a part of stock is not available for the common stockholders, it is some kind of financial security. Like in case of emergency, the firm can issue more stocks
Yeah.
to raise more.
Okay, so that those stocks are with the firm. So that is your point, right?
Yes,
Those stocks are with the firm, so the firm can sell off those stocks if it wants to, right?
yes,
So it's a
yes.
part of its maybe. Okay, so any other question then? Okay, if not, then I'll be ending up here because it's 5 now. So we shall be meeting once again tomorrow. And I'll be talking about the assignment later on. Okay, so let me first discuss some basic issues. Let me proceed up to a certain point, then I'll be discussing about the assignment. Okay, so in that case, if you have any question, you already have my mail ID. So if you have any question, then you can always let me know. Okay, so any other question then? So if you don't have any other question, then we may leave for the day.
Thank you, ma'am.
Okay, okay, then
Thank you
we are
very much.
leaving. Okay, okay, then we are leaving. We shall be meeting once again tomorrow.